Ryan Moore, welcome to the heart of it.
I want a holiday home in Spain, ticked off. But if I'd not put the work in 20 years prior and invested and let that money compound and compound and compound and compound, I wouldn't have been able to withdraw the capital appreciation to put into the tangible assets. Some of my investments, I've literally done over 1,000%.
People are always trying to save their way to wealth. Can't save your way down to zero any less than zero. And so this is similar, right, to Elon and Jeff with their big ass yachts.
Yep.
They're using debt from their stock.
True.
To have $200 whatever billion in cash.
I always talk about good debt and bad debt. Good debt is on assets that appreciate. So bad debt is...
Ryan Moore, welcome to the heart of it.
Thank you.
Business version.
Business edition.
Business edition, yeah. So I started a podcast is it last year, the year before last? Called To the Heart of It.
Real?
I was writing a book, it's still not released yet for legal reasons, about some of the fucked up shit that's happened in my life.
Okay.
Damage I've done, damage I've had, done to me. And I was talking to my infinite wisdom at David Lloyd. And I was like, me and my friend were like, people would listen to this, you know. So I started a podcast. I had quite a lot of equipment still, like from other ventures and different businesses in the past. And then I obviously spent a fortune, not quite this much, but we made a proper studio. It was decent. Bought the kit, made something really quite special. And then someone came on the podcast and said, oh, would you make some videos for us? I was like, sure.
Yeah.
And then the personal brand agency got formed. So we're like, let's sell personal branding stuff, like podcast-led personal branding stuff, like social media videos, podcasts, branding, etc. And then that led to this, which was, I realized how much hard work it was to take the camera files. They're obviously in for 4K or 8K.
Yeah.
Edit them all together and then produce like Stephen Bartlett-esque trailers. And all the reels, and all the copy, and all the.
Yeah.
And then I got a bit of a team. Then I realized they're expensive. So how did you make some money out of this? So we sold some stuff. Then we started building a bit of a software tool. So I got some offshore developers to make me like some stuff, like code, that would like do some of the monotonous things over and over again. This is way before AI agents were around.
Yeah, of course, yeah.
That obviously escalated. Because as we started like playing around with what was possible, I was like, well, doesn't it make sense to just put the stuff all together? Because there's lots of different software things. And we were like, but they all kind of do like half a job.
Well, you've done an awesome job. This place is absolutely fantastic. It's really plush, obviously very, very professional. And even the service, the pickup service with the Mercedes, work while you're on your journey. It's absolutely class so far.
How was that?
Yeah, to only had a 55-minute drive anyway, but...
yeah, because you're Rotherham based, right?
Yeah, Rotherham. Okay, just not too far from Meadowhall, if you know where the shopping centre is.
Yeah.
I'm just one down on the motorway junction.
Oh, nice. So,
verge of Sheffield. I mean, I always worked in Sheffield when I was a teenager and into my early 20s, but grew up in Rotherham. There's not a lot going on there now in terms of like town centre. I mean, other than the football ground, Rotherham United Stadium, but there's not a lot going on too much in the town centre. But there's other little areas around Rotherham that are really, really nice. It's kind of semi-rural. There's an amazing there's an amazing gym there. Obviously training there myself, and I've got quite a few clients that are in there as well, and I know the guys all from Ultraflex really, really well. But yeah, good. I mean, probably Ultraflex has probably put Rotherham on the map in terms of the online fitness space.
Yeah, Charlie's from Leeds, right?
I believe so.
So then he's got like 3 in that sort of Leedsy,
Yorkshire
way.
Yeah, of course, yeah. I got approached as I was walking through Leeds a couple of weeks back. They were just grabbing people on the streets and putting you on the spot, saying...
That tall, dark, handsome, you were like...
They grabbed me as I was just going into the hotel with my luggage in the hand, and they said something... think of a chat line that you could use in the gym. I'm like, what? I went, how big are these? Something like that. But yeah.
How's that worked out for you?
My missus wasn't happy.
So Rotherham, born and bred.
Correct.
Still in Rotherham.
Moved back to Rotherham.
Ah. Yeah. So tell me about when you left Rotherham.
So Rotherham, born and bred, grew up in Rotherham, worked in sales, worked in banking, worked in finance, debt management, then went into banking. At the age of 26, had a fantastic job opportunity pop up in Abu Dhabi.
Oh, nice.
So basically left salaried role with Lloyds Bank. We're doing extremely well there.
When you say extremely well, I like to just ask straight questions. Like extremely well, what, 50, 100, 150 grand a year?
Oh no, nothing like that. I mean, I was early 20s.
Right.
I was probably earning best part of 45, 50 grand salary and commissions.
Yeah.
But we're going back, I think that'd probably be the equivalent of around about 60k.
Yeah.
But I meant like my career progression was going well. So I was senior personal banking manager. I was top performer of Northern England. I think I come second within the whole of the UK on one of the quarters or biannual leagues. One of the guys that I'd worked with at Lloyds Bank, he'd headed over to Abu Dhabi 2 years prior, and he then started this mission of hiring all the top class guys that he'd worked with in Lloyds Bank. So we basically, I think eventually we recruited probably about 10 to 15 of Sheffield lads from Rotherham, Sheffield, from the branches.
What could go wrong?
Well, anyway, we had a fantastic time. But yeah, so he like kind of recruited me over to Abu Dhabi. I took what we call like a BDM role initially. That would have been in 2012, well, January 5th, 2012. And then I spent 9 years in the UAE and basically climbed my way up the ladder from being a BDM to financial consultant, to a team leader, to an area manager. And then in 2018, I jumped ships from that particular network and became a senior partner of a company called Holborn Assets, which is based in Dubai. 2020, pandemic hit. For family reasons, I just had a little girl. My missus and daughter were back in the UK. My dad was a little bit unwell, and I decided to move back to the UK in 2020. And basically, I put my business online. And at that point, I started working with online coaches. And, you know, if you can imagine the amount of people you can outreach and the amount of people you can impact when working online, versus just being a financial advisor that's doing one-on-one in-person meetings. So I was able to open up my books and I put my client bank. But yeah, that would have been 2020, moved back to Rotherham. A lot of people say, how can you leave the flashiness of Abu Dhabi and Dubai and move back to Rotherham? Well, for me, it's just home. I don't feel like a bit of a homing pigeon. Like that's home. That's where my family are. That's where my people are. And the UAE was an amazing chapter of life. Like it, you know, it exponentially put a rocket up my ass in terms of career progression and even my own kind of wealth accumulation because of the fact that you're not paying taxes out there. But it was a fantastic chapter of life. And now I'm back in the UK, family, little kids, close to my mum. My dad passed away last year. Again, one of the reasons why I wanted to be back closer to home and spend like the last 4 or 5 years with him. And this is another chapter of life. And I always say, probably not going to live and stay in the UK forever. You know, it's just another chapter of life. And maybe in the future, I'll move on again and live somewhere else because I don't like to, you know, I feel if you live in the same location for the entirety of your life, you're kind of like a goldfish swimming around, you know. So yeah, that's been, you know, my journey up to now, which, you know, I'm 40.
You're 40 years old.
I'm 40, yeah. I take good care of myself in the gym, work out, live a healthy lifestyle. And moving back to the UK, obviously set myself up as a limited company in the UK. And from that point, with the wealth that we created whilst being overseas and not paying taxes, that's now allowed me to be a multi-business owner. So I've got 4 businesses. A lot of those are property orientated. And then I've got my wealth management company, which is in the UK.
Do you keep all the money that you made in the UAE out in the UAE, or do you bring it back?
So again, it's all about where you're a resident of. So the money that was earned whilst I was a resident in the UK, whilst I was a resident in the UAE and a non-resident of the UK, all that capital has been earned with no taxes in the UAE.
And has to stay there?
No.
You can bring that back.
Once it's been earned and you're a resident there, and also any investments that you've made, all of the capital appreciation, you've got to realize the gain as a non-resident, because in the UAE, there's no capital gains tax and there's no income tax. It's called rebasing. You draw a line in the sand, you repatriate, everything else that you earn once you're back in the UK is subject to income tax, or if you're a company in the UK, subject to corporations tax, VAT. And also all your investments whilst in the UK are subject to capital gains tax, unless you're buying them via some type of vehicle like an ISA wrapper or a pension wrapper, because then that nullifies capital gains tax. ISAs, no income tax. Obviously pensions, income tax on the way out, but tax relief on the way in. So you just got to be quite clever and savvy with what you're doing financially.
Most people have heard the word ISA. That's got a 20 odd grand limit per year though, right?
Correct.
So you're talking about that.
Yeah, so you basically, it's quite a minimal allowance really. Think about it. You can put 20k a year into an ISA, and the money that goes into your ISA, if you have a cash ISA, it's going to give pretty low returns. But if you have an investment ISA, 20 grand a year in, there's no capital gains tax on the appreciation, and also the dividends that the stocks may generate that are held in the ISA, no taxation. So 20k every single year can go into that.
So I know what you're talking about.
Yep.
But in layman terms, being like I'm a 5-year-old, you put 20k into something called an ISA.
Yep.
Investment ISA over a cash ISA, just for what you said there.
Yep.
And then you don't pay any tax on the capital appreciation of those stocks.
Correct.
What are stocks? I've just put an ISA. What do you mean?
Yeah, so stocks are shares of companies. So if you think about all the fantastic, multi-billion-pound companies around the world, companies like Meta, Amazon, Tesla, we just want to piggyback onto the growth of these companies. Okay, a lot of these companies as well also pay a dividend to shareholders.
What's a dividend?
So a dividend is a share of the profit to the shareholders. So if I'm a company director of my own company, I take a small salary and I pay myself a dividend. But you can also be a shareholder of these big corporate companies. And again, as the share values rise, as these companies grow and become, very, very profitable, the shares are rising, the value of the company is increasing, but they're also kicking out a dividend to their shareholders. And you can be a fractional shareholder of these multi-billion, trillion-pound companies. And just carry on from that. If you, rather than trying to buy individual stocks and shares, you can buy into ETFs, an exchange traded fund, and an ETF just tracks the broader market. So for example, most people have heard of the S&P 500, right? So the S&P 500 is the largest 500 companies trading in the US. And the US is one of the main contributors to world's global economic growth. So you can just buy into an ETF via your ISA, okay? So you don't pay the capital gains tax. So ISA, S&P 500, okay? And then you buy, that's 500 company shares in one transaction. So you're not having to be a stockbroker or a stock trader. You just buy an ETF, or you can buy an actively managed fund, okay? And the fund has a fund manager, someone that's qualified, someone that's highly experienced in what they do. And then you can be quite specific about the companies that you own. So again, to give you an example, AI. Yeah, so maybe you just want to invest into 30 of the biggest AI companies around the world. You'd buy an AI fund. And in that fund, there's just 30 companies of AI sector, whereas the S&P 500 is 500 from all different sectors: banking, finance, consumer staples, loads of different sectors and industries, but the largest 500. And then you can even break it down. So again, you've got FTSE 100, you've got Eurostoxx 50, and then you've got below like the FTSE 100, you've got the FTSE 250. So that's the mid cap. That's the medium sized companies. Yeah, and you can, again, whether you go in large cap or mid cap, some of the mid cap have got higher room for growth, but there's also more risk because the smaller companies.
Do they all pay a dividend?
Not all companies pay dividends, no. But again, if dividends are income, right? So if you're income focused and you want investments that are going to pay a passive income, then you'd look maybe for a dividend fund. I think on the S&P 500, the average dividend rate is probably around about 2%. So it's nothing huge.
Yeah.
It's mainly the capital appreciation is where clients make money. So again, I'll give you some stats here. S&P 500, if you go back 40 years, I did that 40 years, I turned 40 in April, and I thought, do you know, what's the history of the S&P 500 over the last 40 years? In the last 40 years, there's been 33 positive years, 7 negative years. Okay, so in any given year, that would have been a probability of an 83% chance of you making money in that any given year. But if you stretch that out over 5 years or 10 years or 20 years, the probability of making profit is pretty much like almost 100%, especially if it's over 20 years, like you're probably talking 99%. But the average return of the S&P 500 over the 20 years was 11% per annum, versus money in the bank, typically 2s and 3s at the minute, right?
Yeah, S&P last year was, what, did 23.3 return.
Exactly. And then if you look at it over the last 5 years, it's averaging 20% per annum. And for me, I think, why is that? I think these growth rates on the S&P 500, the growth rates in the markets, companies now are way more profitable, and companies now are way more bigger than they were back in the 80s, 60s and 70s.
Bigger, but I also think it's fucking hard. Like, you're in finance, you're obviously regulated, so you're not going to ever agree to this comment. But when there is numbers that mean a massive difference between how the numbers are explained, you're going to shine the light on those numbers that make it make sense.
Yeah, of course,
to continue the business model. And obviously banks, investment funds, etc., they make money from transactions.
True.
Among other things. When I started to understand the word of international finance, I was like, huh. It's like almost backwards of what traditional high street banking and lending is about. And I was like, but it does make a lot of sense, because the storylines suddenly make a lot of sense. So when I ask you dividend question, I know obviously certain big stocks that people think they're going to get money from, like Apple, don't. Lots of stocks don't do that. And then another thing, right? You said income. Well, you said dividends is income, but then people get confused about growth portfolios, income portfolios, and I need to produce this amount of income from my portfolio, thinking about how much money they need to actually have cash flow.
Yep.
Because then I have the next thing. They're like, what's the P&L? What's the balance sheet? What's the cash flow for? Like,
yeah.
And then you have to that's a whole other conversation. So when you said about working with online coaches, what is their biggest problem when they contact you, or when you first thought go for online coaches? Of course, I've scaled coaching companies. That's exactly what my business career really mostly was, scaling online coaching companies. So I know exactly the ins and outs of that. A lot of guys obviously all over the different places in the world, not just for tax efficient reasons, just because it's cash flow, milking it central. But when they come to you and when you first started thinking about going for an audience, what made you go for those people, and what were the sort of problems that they were saying to you?
Yeah. So do you know, up until 2021, the majority of my clients were generally older, in the 40s, 50s, 60s, higher net worth, and there were fewer of them. And I was just helping wealthy individuals manage their capital. And a lot of it was, I'm retiring 5 years, I'm retiring in 10 years. Let's final hurdle, let's increase the wealth, and then we can start living from the passive income in retirement. And how I actually got into working with the online coaching space, I hired an online coach myself. Okay, so I had an online coach after the pandemic. Everybody put a little bit of weight on during the pandemic, right? So I needed an online coach. And I hired one, and I was working with him for about 6 months. And he turned around to me one day and said, "You're a financial advisor. I think I need some financial advice. I'm obviously earning more money than I were when I was doing my full-time role. And I'm obviously a business owner." So I gave my coach some financial advice. So he was my first online coaching client, still with me today. We've done phenomenal results with him. He's moved out of Rotherham over to Dubai, so he's now more tax efficient. We've done multiple property investments, pensions, ISAs, and since moving overseas, we've done offshore investments for him as well. And after providing obviously an excellent level of service to the client, he said, "Look, I've got loads of guys in the industry that will want to speak to you. Here's 2 or 3 guys that you could speak to straight away." And after, I don't know, maybe 6 months to a year, I thought, you know what, I actually need to make an online profile. For my Instagram was just me me at one point. And I thought I need to make a showcase who I'm working with, what I'm doing. And it kind of just escalated from there. And then before I knew it, I'm inundated with inquiries from online coaches, and I started making some content and blah, blah, blah. But the question that you'd asked was, what was their biggest challenge, I guess. A lot of these guys, the online coaching space for the top level coaches is very, very lucrative. Okay. I mean, they're doing a good job. They're providing a high level of service, and they're making good money, but it's new money to them. Okay. And people can go one way or the other, right? So new money, they've never had this money before landing in the bank account. They don't know what to do with it. It's a nice problem to have. Okay. But they don't know what to do with it. And then if you don't know what to do with your money, before you know it, you start spending it on shit. Just start wasting it. You can't start squandering it. So, I mean, I always say within my service and the way that I actually financially plan for clients, most people, it's always about, let's just plan for your retirement. Let's just plan for your retirement. I take my clients through the stages of, majority of them come to me and they're what I class as being income rich. Yeah, and again, this is why I work slightly differently to most financial advisors. Most financial advisors are looking for people in the 50s, 60s. We're going to consolidate pensions, and it's good, but it's a little bit boring. I'm actually on the journey with the client. So I'll take clients on from, if you've got 50K to invest, okay, but also can you back that up with a monthly investment so that we've got consistency, that month after month after month with structure and discipline, we're creating wealth and we're achieving wealth accumulation. So they come to me and they were what I would class as being income rich. And if you're income rich, that's great. It's a great position to be in, but it's what you do with the surplus income. So again, speaking to coaches, if you're in a calorie surplus, you're going to gain weight. If you're in an income surplus, you're going to gain money automatically. But if you invest the surplus income, we can exponentially accelerate that wealth creation. And I take them through the process of being income rich, okay, to financial security stage. So what's financial security? Looks different to everyone. It's having at least 5 years income in assets. So if the shit is the fan, your business goes down the pan, or you become unhealthy and you can't work, some type of illness, can you survive for 5 years? Can the assets pay you an income for 5 years? Okay, until you figure things out. Okay. Moving on from financial security stage is financial freedom stage. And to me, again, financial freedom, it looks different for everyone, right? But I just do this calculation, and financial freedom pretty much sounds like retirement. You own 100% of your time. You don't need to work, okay? Because you've got enough wealth that can generate income for you to live on for the rest of your life. Now, how you calculate that is 20 times the annual income that you need. Yeah, so think, again, easy numbers. Let's just go 5K a month, 60K per annum. Okay, 60K per annum times 20 will give you 1.2 million. Okay, and then you go, well, if I've got 1.2 million and that made a steady 5% return per annum, it's kicking out $5,000 a month. It's kicking out 60 grand a year, but you're never spending the 1.2 million. You're living off the profits. But because of inflation, maybe you need more. Because of taxes, maybe you need more. And then you would do income drawdown. But once you get to that financial freedom goal, the reason why we timed it by 20 as well, if you think about retirement, most people retire at 60 and pass away at 80. So there's at least 20 years of income, right? Mm-hmm. But I can get my clients to that goal, like their financial freedom goal, and we just reverse engineer. That's your target. So let's reverse engineer it. How much do you need to invest every single month, and how much do you need to invest now to reach that goal in 5 years or 10 years? Okay. Mm-hmm. And again, the numbers are different for every client because everyone's got slightly different goals. Mm. Once you reach that, let's say you get to that goal and you're my age. Okay. I don't want to retire. I couldn't think of anything worse. I'd just be bored out of my mind. I'd lose all sense of purpose, probably get depressed. Do you know what I mean? So it's about getting there and then saying, well, what's the next goal? And the next goal for me then is what I call financial legacy stage. And legacy, again, especially if you've got children, it means more to people that are parents. How much generational wealth can you leave behind? Live the life that you want to live a fantastic lifestyle, but have assets that can be passed on for generations to come. And again, for me, my backstory was always about breaking the working class chain. I'm the first millionaire in my family. No disrespect to my family, but I'm the one that made it to that level. And now I've got 2 daughters, and I know what I've achieved and what I've established for them is generational wealth. That'll change their paths and their kids' paths, and hopefully their kids' paths, and so on and so on and so on.
Will it because of the money?
For me?
As in, like you mentioned about the people retiring as one sort of audience, whereas being on the journey with people, especially when you said the word new money.
Yep.
How does that new money piece, because is it just the money that's going to affect you mentioned your daughter and your family? Is it the money, or is it the beliefs that you're instilling by all the way that you're managing and treating money? This show is a PodFirst production. PodFirst specialise in cinematic, high-quality video media production and podcasts, including projects such as viral social media content for business owners and entrepreneurs, internal communications for organisations, and charity incentives like Homeless FC. Managing and directing the project from start to finish. So whether it's pre and post-production, branding, guest selection and booking, set design, social media strategy, marketing and management, the list continues. Whether you're a business owner or an organisation, PodFirst is here to help you to achieve your objectives and your vision. If any of this sounds like you, then you can visit PodFirst at www.podfirst.com. That's www.podfirst.com. podfirst.com. How does that new money piece, because is it just the money that's going to affect you mentioned your daughter and your family. Is it the money or is it the beliefs that you're instilling by all the way that you're managing and treating money?
Yeah, look, for me, I like to do things the right way. And again, I don't come from money myself. And for many, many years, I was always very, very much OTT with just squirreling away and saving and, being savvy and not spending and understanding the value of money. But once you have sufficient amount of wealth, it's how that can impact other people's lives around you. So taking care of the people around you is very, very important for me. And again, when I work with my clients, I always say, your vibe is your tribe. I'm looking for people and I'm saying, what's your goals? Yeah. And again, if their big goals are to help family members and create financial security for themselves and the people around them, then I know it's definitely going to be something that we gel well. And again, I get a lot of job satisfaction out of helping the clients go through the journey rather than just somebody coming to me with a big, amount of wealth and saying, manage that. But again, people work in different ways.
Yeah, it's interesting. I mean, everyone's different. And you meet different financial, I've obviously met a lot of financial advisors. Yeah. It's funny you said about your man's gone out to Dubai himself. I set all this up. We've got 4 companies. One's a group. It's a group. Obviously, one holds it.
Yeah.
3, 2 operating companies, an assets company, all based out in Jersey. So if I relocate to Dubai, when?
Yeah.
They just rock and roll straight out.
Yeah, straight away.
It costs a fucking fortune to do it in the way because people are like, why are you doing all that? Because obviously I've not my first time at the rodeo, but I was almost what you're talking now. I was thinking like I've kind of probably followed the same suit this time because I've done it before, and then all sorts of shit's happened. You're planning for success first. So when you're talking to clients, whether it's now starting to become income rich, now they're thinking about investing for the first time. The last thing I'm thinking about investing right now because I'm pumping everything into it. Yeah. But my point is that the structure, people don't know what they need, right? They've got a problem, or what I say problem, it's a nice problem to have.
Yeah, nice problem to
50 grand of it to invest or whatever. But they don't necessarily, I think, and maybe you can correct me if I'm wrong or you have a different opinion, they don't really know there is an issue because when you've got surplus money, especially if you're not come from any, like you, it's what you said. I come from money. Parents wealthy, grandparents wealthy. Obviously, I've had times in my life where I've fucked things up. But because of the way that I operate, clearly I'm very different to normal people. I've been told recently a lot, very different to any normal person. I don't even think in a certain way. So like my belief systems around money is completely different. I do things in a different way to people because I can not speculate to accumulate. I believe there's an abundance of it. So I fucking act like that. And I guess obviously a lot of people are not like that. But I think about a lot of the coaches I know, they're always in this like contraction phase. Even when they're expanding, they're making money, but they're fucking scared.
True. I definitely second that. And again, I have to say to some of my clients a lot of the time, there's more to life than work. And I actually encourage some clients, you can spend money. And I call it guilt-free spending. I said, once you've got all your ducks in a row and you're working hard and you're doing the right things and you're putting your money into the right places and you're reaching financial security, you'll then get to a point where you'll be happy to spend money and it will be guilt-free because you've done the right things. And, if you think about it, we're all trading money for time. And a lot of these guys are working themselves into the ground and, they're going to reach burnout because they're doing 12 and 14 hours a day sat. But it's like you're in your 20s and early 30s, you enjoy life a little as well. And I mean, again, that's not everyone, by the way. And again, I always say to clients, it's about finding balance so it's sustainable. Try and invest as much as you can. But, even if you're investing half of what you're earning and the other half is for you to, pay your rent or your mortgage or your car and travel and enjoy life. I mean, there's not many people in the UK, I would imagine, that are actually able to invest 50% of what they earn. Whereas once they go over to Dubai, and again, a lot of my clients, a lot of my coaches, I advise them on their life, not just also the finance. I'm like, why are you here? What ties have you got? Go to Dubai, live there, tax-free. But just once you get there, be mindful that it's a lot more expensive than the UK and don't get caught into the trap of keeping up with the Joneses and just squandering all your money. The biggest rule I would always say to anyone that's moving over to Dubai is calculate the tax saving and tax yourself. Yeah, so put the tax what you would be giving to Mr. HMRC into your investment. Something that I did as soon as I arrived.
Are you familiar with Grant Cardone?
Yep.
He's got the 40% rule.
Right.
You heard of it?
I've not heard of the 40% rule, but I know he is.
He writes $10,000 on a board.
Yeah.
And he says the IRS are going to take 40%,
Yeah.
which puts $6,000. You tax yourself 40%.
Yeah.
'Cause if they can,
Yeah, why-
you're
why
just
can't-
that, so you might as well. And he said, then you got $2,000. And you realise you're broke.
Yeah.
That life you're living in that Malibu beach house, you can't do that on 2K.
Yeah.
And he says, if you live like that for a long enough period of time until your 4Ks add up,
Yeah.
and he calls it storage, not savings.
Yeah.
And then you invest in something that cash flows. That's exactly what you're talking about.
True.
Then you start getting that number to you realise your income needs to go up.
Yeah.
Because you can't bring your people are always trying to save their way to wealth. Can't save your way down to zero any less than zero. It's just zero. And he said, I would literally, he said, I'd invest my last dollar, try to make $1.
Of course, yeah.
And I've been in a situation before. And I literally was going, people were thinking I'm fucking mental.
You've got to go all in, aren't you, at some
All
time?
in all the
and it's
time.
got to be calculated risks. I mean, again, I call savings accounts degrading accounts. And the good thing with Grant Cardone there that you'd mentioned, and it's, look, the IRS and the US, they have a slightly different tax system to the UK. But there's one thing,
2020 that's how I saw it.
Yeah, but there's one thing that you can do, and again, obviously he's a real estate entrepreneur, right? Same in the UK. Leverage. Okay, so again, if you want to minimize taxes, okay, and you want to get into investing, set up a property company, be a director of the property company. You've got to have some capital. It takes money to make money, so you've got to have your own capital to input. Okay, but then you can buy assets, you can buy property with the bank's money. Okay, so you use the bank's money to buy the assets, you then rent them out, okay, and you get the rental income to pay the debt. It services the debt. You can then keep re-leveraging, okay, refinancing that property portfolio and drawing out the debt as income, but paying no taxes because the debt interest is offset against the tax as an expense. So again, once you've got X amount of properties in your portfolio, you'd never really have to draw a dividend from the company and pay a dividends tax, and you can nullify the corporation's tax by the debt, but the values are always increasing and the rents are always increasing. Therefore, you can keep refinancing and keep drawing out the loan amount. That's what Grant Cardone talks about a lot with the IRS and the US version. But there's a similar model that you can do
Equity
in the UK
line of
as well.
Equity line of credit.
Correct.
And so this is similar, right, to Elon and Jeff with their big ass yachts.
Yep.
They're using debt from their stock.
True.
They have $200 whatever billion in cash.
You've got to be very clever with it and very savvy. And I always talk about good debt and bad debt. Okay. Good debt is on assets that appreciate. So property is an asset. Bad debt is personal loans, credit cards, overdrafts, and even like car finance. It's
Good debt pays you, bad debt you pay.
Exactly. You especially cars, you're putting money into something that's depreciating. You're paying 10% in finance interest, and the car's depreciating by 5 or 10% a year. So you're just writing off money basically. Whereas putting it into property, again, it's yielding and it's appreciating. So it's good debt versus bad debt. And again, everyone's in different stages of life, but if you're just trying to get up to that first 50K or that first 100K or that first 250, 500, even $1 million, to stay clear of personal finance for 5 or 10 years, and don't drive the most flashy car. Use the money that would go into the car payment and put that into an investment instead, month after month. Build a deposit for a property investment, or just invest in stocks and shares month after month. It's the grand old saying of doing the hard now for the easy life later. Yeah, and again, it's basically just been a formula that's worked for myself. I'm very, very proud to say never ever once took a car loan. My car's a pretty average car that I drive compared to what I could easily go out and afford and buy, because I'm more interested in putting money into assets that are going to grow and yield, and more interested in building generational wealth than me driving around in a Ferrari. Although at some point, probably the retirement age, I do want an Aston Martin. I think it just fits the think it just fits the retirement age.
But do you think that's because you understand it, right? Because I agree with obviously everything what you're saying, but it's very difficult to not spend now when you don't really know what you're saving or investing into for, because there's no plan, there's no structure, there's no. And if you say they've not come from money, they've not really seen it before, so they don't really. It's all just like hokum off some guy off the internet saying, "No, save all your money."
Yeah,
or invest your money into a piece of paper, because one day your kids are going to be grateful. You're like, yeah, but the kids will be grateful now for fucking Disneyland. So, like,
I think the more you know about investing, and the more, like, again, the longer you've been investing for, and the sooner you realize that it's actually pretty easy to make money investing. The markets go up more often than they go down. Property prices increase more often than they go down. Property yields, stocks yield dividends as well. It's opportunity cost. I know dropping 250k on a Ferrari versus that 250k into assets, and I know that I can get that 250k to double within 7 years. So the car's not cost me 250k, especially if it's financed as well, because then I'm paying more on the interest. So again, I think people, they don't know what to do with the money. Maybe they're a little bit, they don't have the peace of mind. They almost go into investing automatically thinking they're going to lose money, when it's actually not the case. If you invest into kind of just the normal standard assets, and you invest into like a portfolio, or if you're at a certain level of wealth where you feel that you need to delegate that duty to a financial advisor, again, doesn't have to be myself, but actually delegating the duty of, you know what you're doing, your experience, you've got the qualifications. I'm an entrepreneur and I'm experiencing X, Y, Z. I'm going to stick to doing what I do best, and I'm going to let someone else manage my wealth. Again, I don't know anything about cars. I would never try and fix my own car. I just take it to a mechanic. I'm not a doctor. If I've got an health issue, I go to the doctors. If it comes to finance and you want your money to grow, you hire a professional to do the job for you. And again, then it's also passive and hands off, so that you don't have to take much of your time and much of your mind capacity, and you can delegate your time and your mind capacity to other areas that are income generating for you, such as your business.
Yeah, no, I understand. I guess people want the framework, right? What was going to mind, a former client of mine, we designed this, a coach who helped people to do a certain thing. Very obvious, so I won't say what it is. We designed a sales process, and it had a timeline on it.
Yep.
Because they were getting a lot of pushback about I'll wait to buy this program. So I went through a role play and we played it out. And I drew the item kind of that indicates the thing that they sell on a timeline.
Yep.
And calculated back, if they didn't make the decision today, realistically, the date to leave wouldn't be able to be the date that they thought they could do, because they thought I've got 2 years. Right. So the urgency wasn't there.
Yeah.
So the other's like, wait 20 years, you'll be rich. Well, that sounds fun. But I remember, actually not that long ago, I had a Google sheet open and showed someone money numbers going across the columns.
Yep.
And then I showed them compound interest.
Of course, yeah.
And they nearly fucking fell off the chair, because they were like, if I just left it alone and it annualized just the S&P, was the S&P, even the worst version of the S&P, if you just extrapolate it out.
Yeah. Take the worst 10, 5 years or whatever, yeah.
I said, that must be what it's worth. And they were like, what? They don't understand the fact of stacking it. And then I said, so if you did it today, right now, transferred that money in there, it'll be worth this on this day, date and time in 20 years. Again, assuming all those things have happened. You do it next month, next year, the year after that, when you're ready.
Yeah.
The number went from 97 million to 67 million on one column. But that's like 30 million pounds.
Yes.
I was like, because that's what time costs in compound interest. True. It's not timing the market, it's time in the market.
100%.
But I'm thinking, as soon as he's I know coaches inside out. They're not thinking like that, because they would invest into their business left, right, and centre. If they had a marketing shoot, new agency, new sales process, new salespeople, operational problems, bang. Whatever they need, they'll buy. But as soon as you come along with a stable, reliable, long-term solution, I imagine the pushback that you have is it the right time? I don't understand that. Do I really need it right now? Unless they're looking for what you've got. It's that whole piece of education that's like, that timeline thing is like, I'm just coming to mind, like if they realise, which they don't, what is wondrously possible with equity lines of credit, what you said, and all this, you're not losing access to the money. You're just planning.
Do you know, again, one of the great things, again, depending where my clients are based, so obviously everyone knows if you put your money into a pension, that's long term. So I always talk about money for now is your income, money for soon is your emergency pot, and then money for later. Money for later is money that's going to be locked away. You never intend to spend it. And if it goes into pension, especially if you're in the UK, again, you get your tax relief. So you're saving taxes, better than giving it to the tax man, put it into your retirement instead. And then we can generally, with compound interest, you can generally get your investment. Okay, so 50 grand in today, it'll double within a 7 to 9 year period using the S&P 500. Okay, stats, facts. So whatever's gone in, you've saved tax. Okay,
Past results are not an indicator of previous.
yeah, they're not, but more than likely it's going to continue. And we know with pensions they're locked away, but for clients that are actually overseas and we're just using an offshore investment platform, the capital is always liquid. It's always accessible. So again, I say to clients, look, like you mentioned earlier, stack the cash. Take a percentage of what you're earning every single month, draw it into your personal name, transfer profits from your business, which is a separate entity, into your name so that you're actually creating wealth. And if you've got a goal of buying a nice, amazing villa or something in 3 years or 5 years, we'll work towards that goal. If you haven't got that goal yet, let's just invest and let's just get the value as high as we possibly can. Let's get as much wealth there for you as high as we possibly can, because at some point you're going to come to me in 3 years or 5 years or 10 years and you're going to say, I want to buy this. Okay, maybe it's a holiday home, maybe it's an apartment, maybe it's the first main residence. And you're going to put your investments, you're going to put your profits, the capital appreciation, into a tangible asset. And it's still an investment, but then that investment you're going to get benefit from, you're going to get utility from. So again, I go through life myself, and for all the clients, I say, look, a lot of the times we're just investing purely for ROI. We're just trying to make your money grow. We're just putting your money to work. But at some point, what does it translate to? What makes you happy? Now, for me, it was always, I want a nice big house. So again, over the last couple of years, I built a £1 million house, like amazing, life goal completed. The next goal was, I want a holiday home in Spain, ticked off. But if I'd not put the work in 20 years prior and invested and let that money compound and compound and compound and compound, I wouldn't have been able to withdraw the capital appreciation to put into the tangible assets and to fund these goals.
I totally agree. And I love and hate people like you. Because it sounds incredible. I'm like, how did you do that?
It's the delayed gratification. And again, coaches should know this, right?
Coaches do that. Yes, that's the point. Like, I was just thinking
they should know this. But the amount of discipline.
There's a goal.
Exactly.
Delayed gratification is like, you got to go on stage. I competed.
Yeah.
Got to go on stage on that date. Delayed gratification.
It's a shorter term goal.
It's not about short. If you told me the show was 3 years away, I'd have a goal.
You'd work to it.
Target.
Yeah.
They don't have a target. You're saying change your behaviors, your actions for nothing based on something I'm saying.
Some hypothetical.
Hypothetical.
Yeah.
Because then, as you say, like when you get there, like imagine say, don't do that, because when you'll have kids, they're like, well, I ain't got a kid, so.
Yeah, I know. It depends. Again, there's some people out there, again, it's just mindset. There's spenders and savers. Now, the savers do extremely well with me because they're already programmed to save and scribble away. And then it's just about changing the mindset from saving to investing. And once you've got an emergency fund built, why do you need more than 50 grand or 100 grand sitting in a savings account? What are you going to spend it on? Yeah, that's enough for an emergency fund. Everything else over and above that, let's invest it.
Do people know that? Do people know like how much their monthly money run rate is? Do they know how many months they've got on average?
Yeah, again, I also work with a lot of clients' accountants. So I go, right, I have a meeting with a client. Who's your accountant? I need to speak to him. And then I get the profit margins and the budgets. And I'll often just go in a three-way conversation on a WhatsApp chat with the accountant and the client. Unfortunately, a lot of my coaching clients use the same accountant in Dubai and the same accountant in the UK. So my network's wide and we're all kind of in each other's pockets. But it's great that because you can co-advise the client with the seal of approval from the accountant, and generally we're always singing from the same hymn sheet. If you've got two professionals, the accountant and the advisor, telling you to do something, generally speaking, as a coach, you're going to go, well, it must be right. You know what I mean?
So if there's spenders and there's savers, and savers do really well with you, what do the spenders need to do, learn, understand, change to be able to be effective? So the spenders,
they're the people that need the help most, but they're just too much live for today. And again, some people change their ways just naturally as they go through life and the penny drops, and others don't. And then they get into their 50s and they're like, look, I want to retire in 10 years, and then they're playing catch up. And because they haven't had time, they've got to invest a hell of a lot more to reach the same goal, because time is an investor's best friend. We talk about compounding interest. You can start at the age of 20 from a very, very minimal amount every month out of your salary. And by the time you get to your 50s, you'll have enough money to retire. But if you try doing that and you start in your 40s, you're having to put 10 times as much away every single month. And then, people, I call it lifestyle creep. The more you earn, the more expensive your lifestyle becomes. So that's just natural. There's nothing wrong with that. But you need to be thinking, I'm earning more. So just look at investing a percentage of what you earn rather than a monetary value. Because then as your business scales and the money goes up, it's always a percentage of what you're earning. And again, the spenders, they just need advice. We need to sit down with them and say, look, what are you spending? Let's look at a budget. Okay, where's your money going? Because again, a lot of people know what they earn, but not many people know where it goes. So let's just go through your bank statements. Let's just actually categorize. You can get little apps these days and it categorizes so much on leisure, so much was on food, so much was on groceries, so much was on travel. And you break it down and then you say, right, there's two ways to increase wealth. We need a surplus income. You can either increase your top line and earn more and work harder, or you can reduce what you're spending. And then you've got a surplus income. And it's like, another little tweak is invest at the start of the month. Let's say you get paid once a month and it's the end of the month. Invest first, spend second. So at the start of every month, you pay yourself, you pay your investments first. Depending on what you're earning, you'll live from the remainder of what's left over. You'll have the same quality of life, you'll have the same lifestyle, but you'll get to the end of the month and if you try and invest at the end of the month and you spend first, you're going to get to the end of the month and you're going to go, there's loads of money there, I'll just spend it. And then you're not putting anything aside for investments. Whereas, again, depending if you get paid weekly or monthly or whatever, but as soon as you've been paid, feed your investments, live from the remainder, you'll manage it. That little tweak will help you to create wealth. And it's just a little mindset tweak really of, I need to invest, I need to pay my future self first, and your future self will thank you.
And this money coming from their business, you say you pull it out personal, paying personal tax on it, or are you taking it from a business and putting it in like an FIC service?
So, again, I deal with a lot of clients that are international. I deal with a lot of clients that are UK, and it's why I do really well in my industry, because I've lived international, because I've repatriated. So I've expatriated and repatriated. I'm experienced in offshore financial planning and international financial planning. And in the last 5 years, I've been back in the UK dealing with clients that are in the UK. So for the overseas clients, especially the clients that are based in Dubai, which is probably, I'd say 80% of my clients are based in the UAE. And then I've got clients in the Far East, clients in Europe, and probably maybe 10% of the client base is in the UK. Again, I've only been here for 5 years. But the international ones, their profit of their business can be fully withdrawn. Yeah, the UAE clients, they can take 100% of their profit as income and pay no income tax in the UAE. So it's about taking the money from the company into personal name and then investing that personal money. For a UK resident, a little bit more complicated, because again, if you pull out too much money from your company and you send yourself up to higher rate tax dividends at 33.75 rather than 8.75 to then fund a personal investment, you're already 33.75 backwards. Yeah, you're starting at a 33.75 loss to then invest. So in that instance, for a client, they are much better off funding their pension, and it's an expense to the company. Okay, or company A, okay, which is online coaching company, let's say, set up company B, okay, property company, intercompany loan the profits of company A to company B. You can do that. You're a director on both companies, okay? And then once you've intercompany loans to the profit to company B, you can invest the profits of company A into property.
Without tax?
No, there's no tax on the transfer. There's only tax on a withdrawal. So if you're taking it out as a dividend, okay, there's a tax. But if you transfer in, and you can either do intercompany loan, or you can set up a holding company and basically pay dividends to the holding company, then into the property company and buy properties. But essentially, the easiest way, the most straightforward way, and this is the way that I've done it in recent years. My wealth management company makes profits. Okay, I pay myself a salary and dividends. I pay some of those profits into my pension to reduce my corporation's tax, and I try to stay within a lower rate tax bracket. Also, employ family members, okay, and use their personal allowances as well, again, to keep everyone into a lower tax bracket. Okay, just a few simple tips. But then if there's a chunky amount of profit in the company, that you don't want to extract because you don't want to pay the dividends tax, especially at 33.75, you set up company B. Mine's RGM Property Wealth. So I've got RGM Wealth Management and I've got RGM Property Wealth. We intercompany loan the money over, get your accountant to draw up the draft for the loan. Money then goes into company B. We can then use that money to buy properties. Okay, and then rather than it just sitting in a company account making minimal interest, I mean, I would always advise to get a business savings account, by the way. Companies like Tide and Tandem will give you maybe 3 and 4%. But a lot of people who just have money sitting in a company account making zero. What a waste. Yeah, so either get it just put in, at least have it working, at least have it in a savings account within the business making a few percent. And if you know you're definitely not going to need that money within the company, intercompany loan it and then start investing into property from the second company.
When you say investing into property, is that something you do? Because like entrepreneurs, study coaches are advised, I know heavily, to not become property tycoons because they take the money, then they got a first rental, when it becomes a first landlord, and it becomes a massive problem. Yep. Do you mean that? Or do you mean take my money from coaching company A, give it to company B, mine, yep, loan or whatever, and then you take that money and invest it for them on their behalf as an investment firm or a financial advisor?
Yeah.
Or could you go and set up a Vanguard corporate account and bang that money straight in the S&P?
Yeah, I mean, again, you can do corporate to corporate investments as well. So you can set up a corporate platform and then invest into stocks and shares, and then you pay corporations tax on the profit rather than capital gains tax. But again, good thing what you mentioned about property there, and everyone's, I see these property entrepreneurs on Instagram, and they're pushing, invest into property, it's all passive and blah blah.
Nothing's passive.
It's a full-time job managing property. I have a property portfolio, and I spend a lot of my day doing personal tasks, whether it's refinancing them. I don't manage the tenants myself. I've got estate agents that take care of that. But there's always a problem. Like I've got a property in Manchester. Next door to it, there was a fire. Now all the tenants are evacuated. That's no rent for 6 months, but I'm still paying the debt. I've got a property in Spain. Needed a tourist license to rent it out on Airbnb. It's taking months and months and months and months to get that because they've changed the laws in Spain. There's always an issue. There's always maintenance issues. There's always a boiler. So property investing is great, but the thing that I would always say to people is you need a team to delegate the estate agency management. You need a team to delegate to the mortgage broker. You need to just let people do everything for you, and you almost want to be as silent as much as a silent investor as you can. I.e., I'm financing it. I'm putting my profits into it. You're not going to make quite as much profit because you're paying for the services of an estate agent. You're paying for the services for a mortgage broker. Again, I've always gone into off-plan properties because the brand spanking new, they've got a 10-year warranty, and you're buying in places where there's high demand, such as Dubai or such as places like Manchester City Centre, Birmingham City Centre. And the brand spanking new ones don't really get much problems. But if you're buying older ones and it's the BRR build, rent, renovate, or build, renovate, rent, that takes a lot of work. Unless you're a master of DIY and you've got time to go and do it, stay clear of it. Or again, like myself, I've got a team. The guys that have built my house for me recently, I've said, look, now you're the team, so now we'll go and do more and more. But all I'm doing is putting the money in, funding it, and these guys are going and doing all the work for it, and then we'll rent them out and refinance, get the money back and do another one. But certainly property investing is a really, really good way to accumulate wealth, okay? Especially if it's done it's got to be done via a structured company these days. You can't buy them in personal name, not for buy-to-lets. And also it's a really, really good way of legacy planning because you can always pass shares over to the kids as they grow up. So then of the company, so then that doesn't get stung with inheritance tax upon death.
Has that recently changed?
No, you've always been able to nominate shares. The changes to inheritance tax recently were more to do with pensions. So now pensions fall part of your estate when it comes to inheritance tax, whereas previously they didn't. But
also limited companies have had a change recently about inheritance tax.
I'm not sure. What you elaborate? Maybe I've missed that one.
Yeah, I was at a banking event 6 weeks ago, 8 weeks ago now, PwC and Lombardia Bank. Telling that there's something now. It's not relevant to me, so there's something. Obviously, we've got the 7 years inheritance tax with the numbers, blah blah blah.
Tapers down, yeah.
But there's another thing that's now coming in, not till the next due budget.
Right, and the next budget, yeah.
where there's something where that people are trying to sell their companies off now, because
Okay.
that will be counted in inheritance
In their estate.
in their estate to pass through. Because you used to be to put your,
I
put
have
your kid on a
heard this.
director and bang.
Yeah, I have heard this, but again, the way that I will do it, and the way that works for now, and again, this isn't until your kids are adults anyway. You've got Class A shares and you've got Class B shares, and you can actually start to basically make your kids shareholders once they become adults. So you'll still be the director of the company.
Yeah.
You'll still be the main shareholder.
There's now a cap going on that.
Right. So there's a cap on that coming. Is there right?
There's a cap, or I think it's obviously going to gift the thing within 7 years.
Yeah. So for me, my plan, and again, speaking to my accountant on this, it'd be like, okay, 18th birthday, you're a 5% shareholder.
Yeah.
And then the following year, you're another 5%. So eventually, over
Tapers.
years and years and years, you get to a point where they're 80% shareholder and you're only 20% shareholder, but you're still the director. You're still receiving
shots.
dividends in your retirement, calling all the shots. But eventually, then when you pass away, only 20% of your shares fall into the estate for inheritance tax, as well as other assets such as property that you might live in yourself, and pensions and stocks and shares, etc. But that again is always also with myself when we're talking to clientele. You know, there's nothing wrong with DIY investing, and I encourage anyone to invest, even if it is DIY. Just find your feet, go in small, dip your toe in the water, and you know you'll find your way, and you'll realize over a long period of time that it's quite easy to make money from investing. But the area that a lot of people fall short is not invested in the most tax efficient way. Okay, and again, it's a long thing to think about, but also legacy planning and inheritance tax planning. And again, that's where a financial advisor, yes, you pay a fee for the service, and it's more expensive, but doing it off yourself, DIY, that can work out way more expensive than the charges that you would pay to a financial advisor, because you're doing it yourself. But at what cost? You know, how much tax are you going to get stung for because you don't know about certain changes or certain rules? And also the legacy planning and the inheritance tax planning of 40% being wiped off of your wealth upon death for the, you know, you want to pass it on, you worked hard all your life, you want to pass on your wealth to your kids and your family and your loved ones, and then 40% of it just disappears overnight in tax.
Horrible.
So there's things that you need to do from the day one to plan for that. And things can always change, but it's just about getting things settled right sooner rather than later.
So you said about people paying your fees. Do you actually charge people fees, or is it fees from the assets under management?
Assets under management, yeah. So all financial advisors pretty much work the same. It's pretty fair, 1% per annum on the assets under management. So again, if I talk about, you know, clients being on the journey with me, if you think about it, if I take a client on that's £50,000, that's £500 a year, it's £40 a month fee. Now, I'll take a client on for that amount, but it's like, okay, you need to also be putting 50 in, and I expect at least another 50 every single year for the next 10 years. It's not, I'm not managing anyone's 50 grand for them. It's like, we're going to start with 50, but you know, you can afford at least 5-10K a month every month. And sooner, you know, as the wealth accumulates, again, the client's capital is appreciating. A year later, we're at 100 grand. A year later, we're at 150. And I'm helping them to reach these milestones because I get paid more off the back of that client later. But again, with my clients, there's no contract. If a client ever wants to leave at any time, they're free to do so.
No money charges in, no money charges out.
Exactly, no more fees. But clients will stick around because 1, I'm keeping them accountable. 2, I'm getting them more savvy with their money. And 3, I'm making them a lot of money. You know, it's like, yes, speculate to accumulate. Yes, you're paying your 1% fee, but let's say last year we made 12%. Minus the 1, you got a net of 11. Yeah, and we're making sure you're invested in the most tax efficient structures, so you're not losing 20% in tax. So, and as it all works, I mean, it sounds a little bit cliche, but the more money that we make for the client, the more profits they make, the more they see their values appreciate, the more they want to put in. Okay, so then we're getting capital going in, capital appreciation plus dividends. I call it layering. Okay, and I'm taking them through this journey of, right, you started at 50, 12 months later or 6 months later, right, brilliant, you're at 100, milestone. The next goal is 250. The next goal is 500. The next goal is $1 million. And again, I've got online coaches, by the way, that have started with me 4 years ago, and we're hitting those goals. And it's like, I'm like, I told you so. And you know, and there's a hefty amount of profit, and it's almost like kind of like front loading it. I always say make hay while the sun's shining, because if you can get all that put in within the first 5 years of your investment journey, even if you didn't invest another penny, that would just compound and accumulate for years and years and years. So once you've got to that goal, maybe then you might go, actually, now I want to start spending a little bit more because I know I've got that behind me that's taking care of business itself.
Are these the coaches you start working with, the sort of people who would be sort of bending, 35 to 60,000 a year on masterminds, business retreats?
A lot of my clients, again, twos and fros, not all of them, but a lot of my clients, they've invested so much themselves into education and mentors and masterminds. And, that's why they're actually doing, the business that they're doing and writing the numbers that they're doing. But again, it's also a lot of clients that have, there's obviously, I don't blame anyone for jumping onto the bandwagon of online coaching, because it's, again, the people are doing a very, very good job. They're helping people get fit, healthy, and it's lucrative. And it's almost, if you're big into your gym yourself, something that you're passionate about. So why would you not want to leave your normal 9 to 5 and do something that you're passionate about? But there's some people that have just got phenomenal businesses because they got in there early and they've been doing the job for a long time. So they really, really understand the industry, and they've got the reputation, they've got the marketing skills. And, it's like the longer you've been in business.
Yeah, printing cash.
Yeah,
it's printing cash.
People just come to you, right? But when you're brand new to it, you've got to prove yourself. You need social proof and all that type of stuff. But again, I think one of the questions that we jotted down was, what would be the first investment for someone to make? And I always say to everyone, invest in yourself. Before you start thinking about stock, shares, property, invest into yourself so that you can either scale your business or find a new skill that actually pays you so you've got a good amount of income, and then you need the surplus income. Then we'll start investing into stock, shares, and other assets. But initially, it's all about having the capability and being good at what you do, being the best at what you're doing, so that you're just printing money in terms of doing something that you love and that you're passionate about. And obviously getting yourself to be the very, very best at the very, very best version of yourself. I would say, don't worry about what anyone else is doing. Almost have the blinkers on, tunnel vision. It's you versus you, day after day, month after month, year after year. Keep improving yourself, keep improving your business. The money will come. If you get better at what you're doing, the money's just a byproduct of being successful at what you're doing, right?
Yeah, I think you've obviously spoken to a lot of these questions here in different ways. Because you're right, the mastermind question I ask, because I bet education, people are pumping it in. Personal development, everyone's prepared to pay, or everyone in that space is prepared to pay
100%
for that. But they haven't quite also, unless they are now already working with you or someone like you, haven't made the leap or the jump to I also need the next level upgrade. And the next level upgrade is this.
It is. You know what? I mean, I kind of almost thought everyone used to think, to have a financial advisor, you need to either be like a footballer or a boxer or a celebrity or, someone with extremely high wealth. And there is ultra high net worth clientele and there is high net worth clientele. But most financial advisors, if you gel with them well, they'll be willing to help you. And even if it is a 50K investment, or even if it is even myself, there's certain people that might inquire with me online. I'll always point them in the right direction, even if I can't take them on as a one-on-one client because they're not right yet at that demographic of clientele.
Is that what the minimum is for you?
Yeah, but I'm looking for 50K minimum investment.
But then 5, 10 a month.
And 10K earners or more. But if you come to me and you're like, I'm a 10K earner.
Just clarify, 10K earner or 10K to you a month?
No, 10K earner. So as long as your business is making 10, as long as you're making 10K a month profit or income, I'm gonna look at that and I'm gonna see potential in that client. So I'll work with them, but preferentially 50K to get started. But if somebody just come to me and they said, I've got 50K, but I only earn 1,500 a month, I'm like, you're not the right clientele. I need to see the vision. I need to see what direction you're going in. Okay, because I need to know that we're going to increase that 50K investment to 100 very, very quickly, to 150 to 250. There's only one of me, and I'm probably sitting around 300 clients right now. Ideally, I'm at 100 clients that are all 5 mil clients. Less time for me unless I start delegating to other junior financial advisors, which I'm in the process of recruiting.
Nice. So minimum you want is 50K investment.
Yeah, and that's quite low, by the way. I open my doors to that level, but it's more about the individual. The money's just an open door, yeah. But it's all about who you are. Do I vibe with you? Are you on the right mindset to myself? Do we get on well? Because you got to think, when you hire a financial advisor, it's potentially a 20, 30 year relationship, business relationship. Yeah. are you going to work well with that individual for that length of time?
So what would be the
Because you don't want any ins and outs. Like I'm very, very fortunate that I don't really lose clients, apart from I've had a few that have passed away. My industry, you put people on, and it's a long-term financial planning. You know, we're not trying to do a 12-month transformation or a 12-week transformation. To create wealth takes time. So I know I've got to work with this individual for a long period of time. Do we gel?
Yeah.
But initially, you know, have you got 50K cash to invest? So it's not having 50K in the bank. Maybe you've got 150K in the bank, but you're happy to invest 50K as your first investment. Then also, out of your surplus income, how much have you got spare? You know, at least a 2K a month really would be my kind of demographic clientele.
So you look at like typically, I assume it's a lot of fitness coaches, but not just fitness coaches.
Yeah, I've got clients from all different sectors, and again, my longest standing clients for 14 years.
Right.
Australian couple. They live back in Australia now, retired, worked in the military in the UAE, and again, I helped fully plan their retirement for them. They retired about 4 years ago, and helped them. They've got a massive villa on the coastline over in Australia now. So I've got a lot of older clients. Even I did a lot of work with Etihad Airways, by the way.
Oh yeah.
So if you ever see me in business class, it's usually a friends and family discount from the Etihad clients.
Nice.
So yeah, did loads of work with Etihad Airways, a lot of Spanish and Portuguese pilots, but again, a lot of clients in oil and gas. Even work with doctors, nurses, solicitors. These were all the UAE, Abu Dhabi based clients. And then it wasn't until I moved back to the UK in 2020, hired an online coach. It's you know, I always think it's like how life, it's like a domino effect.
Yeah,
that little thing there, I hired an online coach because I needed fitness coaching. And then that escalated into me saying to my coach, I'm going to be the number one financial advisor that all the online coaches come to. And I mean, I don't know of any other financial advisors that are really, they're like, online coaches are my niche. They're not the only clients that I work with, but they're my niche. And I've had a lot of conversations with many of them, and I've got a lot of them that are clients. And even if there's any online coaches out there that aren't a client yet, I'm always in my mind, I'm like, they're probably going to become a client at some point. You know, I'm always speaking to you. I'm always bumping into someone. And again, I'm in that circle where my clients sing my praise. You know, they introduce people to me. They refer people to me. I never even asked for that. It's because the fact that I've got such a good relationship with the clients. A lot of them have actually become friends. I'm like good mates with them. When I'm over in Dubai, we'll go out and beach club and all that type of stuff. And they know that I care about them, and they know that I want the best for them, and they know that we're doing well. Like the progression that we've made, again, I find investing and making money in investments easy because it's what I'm qualified in, it's what I've studied in, it's what I'm experienced in. But to these guys, they're like, oh, wow, I'm making money. Like, it's true. I'm like, yeah, of course it's true. Money makes money. It's pretty easy to make money from investments. But as soon as they see it, and again, it doesn't always go immediately to plan. You know, sometimes the markets can drop, of course. Everyone knows that, you know, there's volatility. But the strategy that we use is unit cost averaging. So a lump sum goes in, and even if markets come down, I welcome that. I'm like, that's a good thing. Yeah, that's a gift. We're now buying units at 20 or 30% cheaper than you were last month. So again, I'm very, very proactive. We have this conversation about you can't time, it's not timing the market, it's time in the market. That's true. But there's also very, very good times in the market when you should go balls deep. You should go in fully.
When there's blood in the streets.
Yeah. So basically, yeah, you can't time the markets perfectly. Markets are usually going up, and you don't want to wait on the sidelines because you might miss 5 years of growth. So you go in, but it's always about keeping some cash ready available, or even being able to remortgage and refinance and release equity so that when there is a crash, we're going hard. So I got into banking in 2007 financial crisis. I didn't have much money at that point. I was 23, I think. And I remember that financial crisis, and I remember it being a stressful time in the bank. And I remember all the financial advisors saying, now is the best time to invest. And I'm like, I've got about 10 grand savings. I've just bought my first house. Like, I ain't got no money to invest, but I was waiting. I'm just waiting for that day to come. And I was investing the whole way through. 2011 was a little bit ropey. 2018 was a little bit ropey. March 2020 pandemic, markets dropped 30%. I literally doubled my investments that particular month. I put everything I possibly could in, and 5 years later, again, I've done some. I already
know the maths on that.
Yeah, I've done some, because I've got a strong foundation of a portfolio. By the way, like I've got a foundation. When I say a portfolio with a strong foundation. Think about building a house. If your foundation's not strong, it's going to topple. So you need your cash reserves. You need some fixed income in there. You need some commodities in there. You need your global equities, ETFs and funds. And then the stuff on the top is the icing on the cake. It's the roof. Okay, but if you've not built that correctly, it'll crumble. But if you've got a strong foundation, you can then take higher risks with a small percentage of your money. And again, some of my investments, I've literally done over 1,000% within a few years. Yeah, and then again,
But that's not you're not swinging for that fence every time.
No,
you have no fucking balls.
Yeah, but you wouldn't go from cash straight into these investments. You've got to make sure you've got your steady stuff that are just making that typical 10s and 12% per annums and 9% per annums, and some years it's down. But again, you can. I'm not saying it's easy to beat the market, but if you're just in the market and then when it crashes, you invest more, you double down on your investments. When the markets climb, you will get a higher return than the average of the market, or you'll beat the sector. You'll beat the sector average, and you'll beat the sector.
So against psychology, isn't it? People panic, right?
Oh yeah,
it's mad.
It took me years and years and years, because there's been certain investments where I've done an investment, the markets have gone down. I'm gone, that investment's it's poor, it's not working well. I'll take the money out. Lo and behold, 6 months later, 12 months later, it's rocketed, and I've gone, I made I missed the profit. So it's just experience. It's just about holding your nerve. Buying and holding. I don't trade. Buy and hold. And if you buy something and you believe it's a good investment,
it's fundamental, right?
And it drops down, it's an even better investment now, because it's cheaper than it were when you first went into it.
Yeah, so when I started learning about fundamentals, I was like, but the fundamental thesis still remains true. There's obviously a time that's and then when I started understanding that markets, the whole point of the market is, if you look at the bars, it's growing and contracting every time, all the time. That's how the growth comes. True. It has to be a contraction. So I was like, you expect it to do that. Hopefully it doesn't fall off a fucking cliff like COVID.
It's completely normal. Markets go down most years, like broader markets, stock markets, they go down most years by 10%, okay, but still finish the year as a positive most of the years. You'll get a correction, so 10% or more most years. A crash, okay, something significant, 20% to 30%.
18.
Probably once every 7 to 8 years on average. So expect them, the normal, welcome them, because it's those crashes that can actually make that, those periods actually make people more wealthier in the long run if you capitalize on it.
But you have to be ready to roll, right?
You have to be ready to roll.
You have to be in it first.
You have to be in it first, so you're gaining experience. Don't forget, like the whole time that you're investing, it's all about just gaining experience and understanding that these are the markets, and the markets don't care about you, but the markets are always climbing. I always say it's almost like it's an uphill roller coaster ride. You got to be in it for the thrill, and it is going to come down at some point. But having that cash, and especially with online coaches, they're earning that much money on a month by month basis. Even if it's down, like the market's a series of peaks and troughs, right? So peaks and troughs. It's a series of peaks and troughs. If it's a trough for 6 months, and you are funding 10k a month in, that 60k is buying more units.
Cheap
but
units,
if you can afford actually 20k a month during that 6 months, you're doubling up during that period. So again, for me, it's about moving the parameter with the clients and pushing the clients when they need pushing, and pulling back when they're not needing to.
It's a good analogy though about the macros thing, because that's exactly right. It's so unintuitive, like when you're competing, certainly, to like be doing the behaviors that way round. Because if you tie it to macros, excess, deficit.
Exactly.
But then it's the same when if the coaches that are competing or have competed, they'll understand it's a different game in the last week. It's about, you've done all that for the long time.
Yeah.
And that last week, you go against everything you've done before because you have the foundations.
Yeah.
You're already in the condition. You're not putting fat on now. You are literally dropping water. You're doing all the different things. Nothing's going to be done there. The work is done. And what you're almost saying is build a foundation, and then when it feels completely unnatural to plow in when it's cheap, that's what's happening. Like, look at every other time the market's pulled back.
Yep.
Your hands then recovered and then expanded. So therefore, like, I'm not saying it because I'm like, believe me. It's like, look at data. It's just facts.
Data.
I got a former client of mine, a passed to a financial advisor, friend of mine back in the day, at the exact moment you're referring to. And she poured her entire net worth pretty much in at 40% down. And I already know. I was like, and I just calculated roughly in my mind. It's like, oh, fucking
I know. It took me a good, maybe 10 to 12 years just to get. inertia, get momentum. And there's some years you're like, I'm not really making much. But you get to a point then where you've got a lot of money working for you, but you're also really experienced about the markets and the industry. And when those moments happen, the last 5 years, my wealth quadrupled versus the previous 10 years. Yeah, because I had more money working and also was able to spot the opportunities because I'd gained so much knowledge and experience of investing for that period of time.
Yeah, it's so tough in it. I'm just thinking how difficult it must be if they're not completely already aligned with your belief system to convince someone that, hey,
there's going to be a lot of trust involved.
Yeah, that 20 grand you're spending now on masterminds, every time you spend 20 grand on a new mastermind or whatever, you make 400 grand. But give me 20 grand a month and you'll see it in 17 years. But you're not saying that. It's that visual representation. I bet a lot of these people are visual as well. That compound interest thing. Because as you said there, once the foundations are stacking, then you've got something to leverage. Leveraging a little is still a little.
Yeah. And you know what, again, I always say to clients, and you've got to, it's about tweaking your mindset. Money today, it's just numbers on the screen. Okay, you log on to your banking app, whether it's a personal banking app. Okay, I've got 100 grand in my bank account. You log on to your business account. Okay, I've got 250 grand in my business account. It's just numbers on the screen. You log on to your investment app. I've got $500,000 on the investment app. Okay, just numbers on the screen. The only difference is these numbers are working for you. These numbers are growing. And when you put the money from your business or from your personal name into the banking app, it still belongs to you. Sorry, not the banking, into the platform, into the investment app. It still belongs to you. It's still your money. You're not parting with the money. You're just moving it from A to B. And by putting it in B, you're giving it the opportunity to grow. So again, little mindset trait that I always say to clients is, think about your money as an employee. Okay. Sometimes you need to crack the whip. If you've got a lazy employee, you're going to either get rid of them, or you're going to fire them, or you're going to ask them to work harder. So when you look at your money, if you've got a substantial amount of money, that's almost like an employee generating profit into the business. So get the money working, but it's not going to work if it's sleeping. If money's in the bank sleeping, money in the bank's degrading because of inflation. It's being eroded every single year. Inflation is a silent thief of wealth. If you just leave money there in a bank account for 10 years, it's going to probably be worth 30% less over the 10-year period. So it's about getting the money working for you. And again, it's either transferring profits from your business over into a pension or withdrawing the profits and then investing into your investment app, whether it's an ISA or an offshore platform, and then having it in the markets, but actually having it into what I call a risk-rated portfolio. So again, there's nothing wrong with just investing into the S&P 500, especially if it's a month after month investment. But if you want a portfolio that meets your financial goals, objectives, and risk appetite, okay, and what might be right for you today is not necessarily going to be right for you in 5 years or 10 years or 20 years. So it's about finding the right portfolios that are risk rated. Again, and that's where a financial advisor comes in. And, you know, we have multiple different portfolios that meet different clients' requirements and needs and objectives. And again, some people come to me and they'll say, I want X amount of passive income. And I'll be like, well, you live in the UK, more income means more tax. You actually need to focus on growth. You actually need to focus on growing your wealth and delaying the taxes, actually pushing the taxes, kicking the tire down the road so that when you're in years to come, you've got more wealth. But at that age, you maybe not got your business income. So you're paying less tax and then you can generate income. And if you start getting more, if you start investing today for income, that means more tax deduction. More tax means less wealth. Less tax means more wealth. So it's about really, really being tax savvy with your investments so that you can actually accumulate as much wealth as possible and then rely on the wealth to generate the income when you truly need the income. And that's the mindset block that a lot of people need to kind of work through.
What's the solution?
Work with a financial advisor, someone that's trained, someone that's trained to make it clear. Yeah, again, we're just helping clients get from A to B, whatever their goal is. And again, bit cheesy, but it's a sat nav for your finances. If you're going on a long journey, you put it in your sat nav. I'm here. I want to get to that destination. Okay, the sat nav gives you the route. A financial advisor, wealth coach, wealth manager, financial planner. They're just going to give you the route and they're going to make sure that the investments and the assets align with your financial goals and objectives.
So if people want to find out more about you, where can they find you?
Best just to grab you on social media. On my Instagram, it's Ryan_wealth coach. All my again, there's reels on there. I try and put a little bit of educational stuff out there as well, but you can go into my links. You can download my guide to investing. We do webinars and seminars every now and again. And I'm always open to direct messages. Anyone's got any questions, pick my brains. If you want to book in, meetings are free of charge, no obligation. Fill out an inquiry form and we'll take things from there.
Nice. Is there anything here that you want to go through in particular?
I think we've covered a lot of stuff off there, haven't we? I mean, it wasn't in exactly the same orders that we'd but I think we've covered everything that we needed to say, in all honesty, buddy. A lot of information shared. It was good. I enjoyed that.
Yeah. What do you think your biggest takeaway from explaining it like that was? I also read them. I just thought, I like to ask questions, so I'm like, just ask it.
Just fire them off. You know, sometimes I like a framework, but once you get into the flow of things, it's just better to ping things backwards and forwards. Again, I think your audience, there's so much information shared there. I think a lot of the information shared is more about, it's like kind of motivational stuff, not necessarily facts. I know there are a lot of facts and figures for people to take away, but it's like,
it's the frame.
It's inspiring people to go, do you know what? Like, I mean, how many times did I say, you can be a DIY investor. It's easy to make money from investing. And it's just giving people that confidence just to dip the toe in the water. And within 2 years and 3 years and 5 years, you know, we might be out of a job eventually, but you know, there's always going to be high net worth people that need the bespoke financial advice. But everybody should be investing. And you know what? It's such an old fashioned thing that in the UK, Americans are completely different, right? Yeah. In the UK, old fashioned, money in the bank, and I'll get a mortgage on my house, and I'll have a pension through work. But entrepreneurs don't have the pension, do they? They've got a plan for themselves. And it's not norm for people to invest into stocks and shares. I think now in this day and age, more and more people are getting a little bit more savvy to it. More and more people are getting a little bit more wiser to it. But in the US, completely normal for people to have an IRA and invest in stocks and shares. For people to have, I think it's a Roth, which is Roth. So although it's completely normal, just the normal general public know about the stock markets and invest into S&P 500. In the UK, people are a little bit more reserved about it. And again, I think it all stems down to as well, I mean, I don't know if you'd probably agree, no one's getting taught financial literacy. No. At the age of 15, 16, you should be taught in school or college or A-levels or whatever, credit cards, debt, mortgages, assets, property. They should just give it a layman's term course for everyone to understand.
Fucking budgeting.
Yeah, how to budget.
What you said about the 10K. 10K is not 10K. Like, again, everyone's different, but 10K in a business means fucking 6.
Yeah, once you've stripped everything out.
Minus all the fucking wages means minus £450,000. But like, realistically, people like, they spend that. They got a tax thing. So if they're spending 10K after the VAT, if they're in the UK, so they're probably left with 6. But they don't see it like that.
I've got 10K, I'll spend what I want.
They do. I coached an Australian guy, former KPMG partner, who's now a financial coach in Australia. Yeah. And he said to me, one of the things I said, what's the biggest problems? He said that they treat their bank account, they treat the money in their bank account like it's theirs.
Yeah.
And he said, so they'll, one day, 29th of the month, they are rich.
Yeah.
And their fucking bill comes and they're broke. And they literally think that they look at the number on the cash point, it says available balance. And like, oh, mine.
Ours, yeah. Especially when you business company, business owners and corporate accounts, etc.
I think that budgeting bit is like when you said about like Grant Cardone says that number, I was like, oh yeah, the buckets part, like put that over there, put that over there, put that over there.
Do you know James Gibson is? He's Fit Pro Financial. He'd be a good guy to have on your podcast. He's one of the accountants that I work closely with, and we go in three-way chats with the clients. He's a bodybuilder. Yeah. Okay. Accountant. He only his business is helping online coaches. Yeah. So again, that's why me and him come into kind of Batman and Robin type duo.
Who's Batman?
I'll be Batman. He can be Robin. But basically, do you know, like you've got reactive accountant, like your normal standard accountant. Okay, that's your tax bill. Oh, it's too late now. I've gone past tax year end. You know, I could have done something about that tax bill if you'd for me. James is very proactive. So he gives the client a monthly summary of this is how much sales you need to make to pay X, Y, and Z, and this is what you can pull from the company.
Targets.
So basically, it's just and they get a budget every single month for the company, and then it's like if you want to take 50 grand a year out of the company, your sales, the KPIs need to be this, your retention needs to be this. and your tax and your VAT is this, and that needs to go in that pot. This is what you're left over with. Now, do as you please with that. X amount of it will go into your investment, and the rest of it is for you to spend. So that 10K a month, like we say, it's not 10K a month. You're probably coming out with three and a half. You're coming out with $3,500. You know what I mean? And again, this is why I've said to a lot of my clients, you're 25, you're 26, you're 28, right? You're an online business. You've got no kids. What's tying you here? Like you're living in your mum and dad's bedroom. Like what's tying you here? Move to Dubai, go and rent somewhere, reasonable expense. Don't get caught with a flashy lifestyle. Go to a nice gym, get some time in the sun, great quality of life. Don't stop giving 100 grand away a year to the tax man. We can invest that 100 grand. So I'm like giving them a little nudge and a kick up the arse and saying, look, when you get there, I can still advise you. You're a client here, but you can be a client there as well.
I definitely think the consequence, if the content that you spoke about was the consequence, and I mean, what I mean by that is that 100 grand is right now just like, well, yeah, but if I told you what that 100 grand would be worth in 10
opportunity cost.
years' time, you'll be fucking like, what the fuck? Straight out to Dubai.
Well, look, I did 9.5 years there, and it was just a life-changing period of life. And again, I came back to UK because my gut told me that was the right time. And, sometimes I think, did I make the right decision? Right now, I'm like, it was definitely the right decision because of family, again, because of family reasons. But would I do everything again in exactly the same fashion? Completely. Again, it just exponentially changed my life, my family's life. And the fact that I was able to earn tax-free money and invest tax-free money just escalated the wealth creation journey. And again, anyone that's maybe listening to this that, is contemplating, is it the right thing to do? I used to say to people, if you're earning around about 10K, that's a reasonable wage to go to Dubai. Inflation and cost of living's increased. It's probably 12.5 grand a month now is the marker. If you went there and you rented somewhere fairly cheap and you lived a reasonable lifestyle, you'd be able to invest at least half of what you were earning.
That's mad, isn't it?
Yeah. Whereas here, you'd lose half of what you were earning in tax.
It's just free money that then compounds and has babies. Like Grant Cardone always said, again, another quote from him.
Yeah, reproduction.
Money. And he says as well, this one really hit me. He said, have you ever had money in your bank account that stayed there? I was like, it seeped away at some point, innit? I was like, oh yeah, money. He said, if you leave money anywhere, so if I put £10 down there, dollars,
it's going to either spend it, save it, or
it's going to go somewhere.
True.
I was like,
out of sight, out of mind.
And that's why I was just, and then all those little nuances were like,
yeah,
you've got to pump it.
Do you know what's great these days, though, is there's so much information out there on social media.
Too much.
Not all of it's great.
Yeah, too much though.
But there's at least people, the younger generation now that are coming through, they're going to be a lot more financially savvy and have a lot better understanding of finances, investing in property and assets than the older days.
True, but you are talking about online coaches, right? So fitness guys, there is enough diet information in the world and people are still fat as fuck.
Yeah, true. You're right.
There's execution, right?
Yeah, it is.
What you're really
implementing
stuff
stuff
to do is actually
take action.
Take action. Well, there's two parts. Take action, and then like you're actually doing the action.
Yeah, we're doing the thing. It's hands off for the client. We try and make things other than actually making a transfer. And I mean, initially the onboarding process, we have to go through KYC and AML and prove who you are, who you say you are, prove where you live, and prove that
that address is wrong. That date's now out of order. That fucking thing's wrong.
There's all that shit to start with. But once we set up and the client gets the app, they can see stuff. The only thing they've got to do then is transfer money, and everything else is hands off approach. Even me, again, I'm the financial advisor. I'm making recommendations. I'm sourcing the investments. But then even I'm delegating to the fund managers that manage the portfolios. Do you know what I mean? So it's like, it's just delegation. And again, that frees up my time and it frees up their time as well. But yeah, certainly it's just more about them taking action and implementation and then getting someone to actually do the job for them so that they can focus on making as much money as possible. And like, I say that you just keep doing what you're doing. You just keep working hard. You just keep doing what you're doing. You just keep bringing the money in and I'll show you where to place it.
Makes sense.
True.
Thanks for coming on.
Brilliant. I enjoyed that. It's been awesome.